All right, let's get right into it. If you're looking to start a business here in the UK, you've got a huge decision to make right out of the gate. Are you going to be a sole trader, or are you going to form a partnership? This is a massive choice, and today we're going to break it all down for you. And let me be clear, this is so much more than just a bit of paperwork. The path you choose is going to directly impact your taxes, your personal financial risk, and even how big your business can grow in the future. Honestly, getting this right from day one is absolutely crucial, and that's exactly what we're here to help you do. Now, to make sure you're getting the best, most practical advice possible, this entire discussion has been put together with the experts over at My Tax Accountant. They're the pros, and they're here to help us slice through all the confusing jargon and get right to what really matters for your new business. So here's our game plan. First, we'll introduce the two main contenders. Then we'll dive into how fast you can get set up and who's really in charge. After that, and this is a big one, we'll tackle personal risk. Then we'll get into the numbers with taxes. Look at your potential for future growth, and finally, bring it all home to help you figure out which path is yours. Sound good? Let's go. Okay, first up, your first big decision. Let's properly meet the two main players on the UK's business startup scene.
So, on one side, you've got the sole trader. Think of this as the solo flyer. It's just you. You are the business. You've got 100% control, you call all the shots, and best of all, you keep all the profits. It's the ultimate freedom. Then, on the other side, you have the partnership, the team venture. This is where two or more people team up, sharing the work, sharing the responsibilities, and, of course, sharing the profits.
You know, it might actually surprise you to see just how popular the sole trader model is. A whopping 76% of all UK businesses are run this way. It is the go-to choice for countless freelancers, consultants, and small business owners, from a web designer working from home in Bristol to a new coffee cart owner in London. But why? What makes it so popular? Well, it all comes down to simplicity, which leads us perfectly into our next point.
That popularity brings us right here. Setup, speed, and control. This is all about the practical stuff. How fast can you actually launch that brilliant idea of yours? And once you do, who's in charge?
For a sole trader, the appeal is just undeniable speed and simplicity. All you have to do is tell HMRC you're self-employed and boom, you're in business. Decision-making is all you and the admin is super light. A partnership, well, it's naturally a bit more involved. Decisions are shared, which means you need to talk, you need to compromise, you need to agree. But a key point here for both is privacy. Neither of you has to make your accounts public, unlike a limited company.
Okay, and here is a pro tip that is absolutely non-negotiable if you're even thinking about a partnership. You must get a written partnership agreement. I'm serious. Think of it like a prenup for your business. It lays out exactly how profits are split, who's responsible for what, and critically, how you'll handle things if someone wants to leave. Do not skip this. It can literally save friendships and your business down the line.
Okay, we've covered the easy stuff. Now we need to talk about the most critical piece of this puzzle. Risk. And stay with me here, because understanding your personal liability, your financial safety net, is probably the single most important factor in this whole discussion. It's a big one.
Right, let's be crystal clear about what unlimited liability means, because it applies to both sole traders and general partnerships. It means there is zero legal difference between you as a person and your business. So, if the business racks up debt or gets sued, creditors can come after your personal assets. And I'm talking about your house, your car, your personal savings account. The stakes are incredibly high. This table really lays out the stark reality. As a sole trader, your liability is unlimited. But in a general partnership, it's arguably even riskier. It's shared unlimited liability. That means you could lose your personal assets because of a debt that your partner created. Now, insurance definitely helps, but there is a much better shield. It's called an LLP, or a limited liability partnership. You can think of it as a kind of hybrid. It runs like a partnership, but it protects your personal assets by creating that legal separation. For a lot of people, it's really the best of both worlds. All right, let's switch gears and talk about the thing on everybody's mind, money. Specifically, how you're going to be taxed. We're going to use the numbers for the 2025 to 26 tax year to see how your choice of business structure directly hits your bank account. The first magic number that every taxpayer in the UK needs to know is £12,570. That's your personal allowance. Whether you're flying solo or you're in a partnership, this is how much profit you can make in a tax year before you owe a single penny of income tax.
So, the moment your profit goes past that £12,570 allowance, HMRC comes knocking. For the 2025-26 tax year, you're looking at paying 20% income tax on your profits
all the way up to 50,270 pounds. If you earn more than that, the rate jumps to a hefty 40%. But wait, that's not all. You've also got national insurance. Just think of it in two parts. There's a small flat rate you pay each week called Class 2, and then there's Class 4, which is basically an extra 9% tax on most of your profits. It definitely adds up.
Now here's a really cool detail about partnerships that might surprise you. The business itself doesn't actually get a tax bill. Instead, all the profits are divvied up between the partners based on what they agreed. Each person gets their individual share, and they're responsible for paying their own tax on that slice. And this leads to a pretty powerful little trick.
And that trick is called income splitting. Let's check this out. Imagine a business makes 60,000 pounds in profit. If you're a sole trader, almost 10 grand of that profit is going to get taxed at that high 40% rate. Ouch. But what if you split that exact same 60,000 pound profit between two partners? Now they each have an income of 30,000 pounds. See what happened? Both of them are now only paying tax at the basic 20% rate. The end result is a much, much lower total tax bill, all from the same amount of profit. That is a massive potential win for partnerships.
So, you're all set up, you've got a handle on the tax situation, but what about 5 years from now? 10 years from now? Let's talk about the future. Which of these business structures is really built to scale?
When it's time to find money to grow your business, there is a pretty clear divide. A sole trader is usually limited to their own savings or whatever a bank is willing to lend them. It can be really tough to get an outside investor interested. A partnership, on the other hand, starts day one with the advantage of pooled resources from all the partners. That combined financial strength and shared risk just gives them way more credibility when they walk into a bank or talk to an investor.
And here's some really great news. Your first choice isn't forever. Loads of successful businesses started out with a sole trader who later brought on a partner to really kick things up a notch. And the process is pretty straightforward. You find the right person, someone with skills that complement yours. You draft that absolutely essential partnership agreement we talked about. You register the new partnership with HMRC, and then you just double-check that your insurance is all up to date for the new setup.
Whew! We've covered a ton of ground, haven't we? From the setup and control to the scary stuff like risk, all the way to tax and growth. So let's tie it all together and help you figure out which path is the right one for your business.
Okay, let's just boil it right down. You should choose to be a sole trader if you want 100% control, you're in a pretty low-risk industry, and your main goal is to get started fast and stay lean. A partnership probably makes more sense if you like the idea of collaboration, you want to share the financial risk, and you have big growth plans that are going to need more than just one person's resources to pull off. It's that classic trade-off, isn't it? Total independence versus shared strength. So, at the end of the day, it all comes down to this one question for you. Do you see yourself as the sole captain of your ship, charting your own course with total freedom? Or do you think the journey will be better, safer, and maybe even more successful with a co-pilot right there beside you? There's no wrong answer here, only the one that's right for you. Look, this is a huge decision, and you absolutely do not have to make it alone. If you want some personalized, expert advice to help you pick the right structure, handle all the tax stuff, and really plan for your future, the team at My Tax Accountant is ready to be that guide for you. You can reach them directly on WhatsApp or give them a call at 078-54-255-375, or just pop them an email at info@mytaxaccountant.co.uk.
And for more expert advice just like this to help your business not just survive but thrive, make sure you hit that subscribe button. Thanks so much for joining us today, and we'll see you in the next one.